Welcome everyone to day 2 of the Municipal Finance Conference here at Brookings. Thank you to our Brookings hosts and all who worked hard to put this on. This is breakout session 2, track 1. Let's check if you're in the right place, on the right plane. I struggled a little bit with the topic for this panel, the name of the panel, and I worked on it a little bit last night, and I think I came up with something here I just wanted to share. So this panel is the privatization of municipal debt, its impact on climate change through the pricing of U.S. green bonds, and the resulting correlation to newspaper closures on public finance. I think it has a ring to it. Let it grow on you. But our first speaker, as it relates to that first third of that title, speaking on the privatization of municipal debt, is Ivanov, who is here from the Federal Reserve. He's a senior economist in the stress testing area. Prior to joining the Federal Reserve, Ivan was a financial economist at the U.S. SEC from 2012 to 2014. Ivan's research examines questions in financial regulation, financial intermediation, banking, corporate finance, and public finance. His most recent work in financial regulation studies the design of bank supervision programs, demonstrates the causal impact of supervision on bank lending, and highlights the benefits of continued disclosure to bank supervisors, for which the banks are eternally grateful, I'm sure. Ivan's recent research in financial intermediation has focused on understanding how bank credit helps companies manage liquidity shocks. His research has been cited in the Wall Street Journal, the Financial Times, and the Harvard Law School Forum on Corporate Governance and Financial Regulation. Ivan earned his PhD in finance from the William E. Simon Graduate School of Business at the University of Rochester in 2012. Ivan, thank you for your paper. Come on up.
Thank you very much. Thank you very much for inviting me. I'll just make sure to stand close to the microphone. Okay, so I'm going to talk about the privatization of municipal debt, and this is joint work with Tom Zimmerman. First I wanted to say that these are our own views and not the views of the Fed or the Federal Reserve System. So what's this paper all about? After the financial crisis, we've seen the financial position of a lot of state and local governments weaken, and the most common cited explanations for that has been like rising pension obligations, rising healthcare costs, and higher than ever, or like record high unmet infrastructure investments. At the same time, state and local governments have increased their reliance on bank loans, and here on this graph you can actually see this trend. So the black line would show you the bank loans. So the black line shows you the bank loans, and basically this is the right axis here, and then the gray line shows you bonds. That is the left axis, and like as you can see on this chart, loans have increased substantially since 2006, from almost like 30 bill to like more than 170 bill, and for bonds we've had no change since 2010. The goal of this paper is to shed some light on this trend, and this has been very difficult because there is no information on the muni bank loans, right? So we only have information on the bonds, and I think the major reason for this is SEC doesn't have a formal requirement to for the state and local governments to show their bank debt, so I think they're working on a rule right now, but as of this point, you have no formal requirement. So what we do in this paper is we basically look at loan data for the state and local governments, and we studied the muni bank debt market. So just to give you a brief highlight of the results of what we find. The first goal of the paper is just to show you how these bank loans look like So the first thing that stands out is that bank loans have like higher contractual seniority. So they have high priority, they're secured, they have the highest security, they have short maturities, and sometimes includes even like additional like contractual guarantees. So the story that stands out from these summary stats is mainly that basically the muni entities that are not that are in poor like financial health, they have to somehow open up debt capacity. And like one way to do this is to like include new lenders that would have like higher seniority as compared to the bonds. Okay, so the second part of the paper, we show that a lot of these entities have substantial risk. And then in the last part of the paper, we ask like whether this trend towards increased reliance on bank loans is likely to keep going. And what we do there is we see how these muni entities respond to income shocks. So we find that basically adverse income shocks lead to high reliance on bank debt, and this comes from both like long-term shocks and short-term shocks, and then we conclude the paper. Okay, so where do these data come from? So we use two sources. The major source we use in the paper is the data from the Fed, the Y14 data that would give us unique opportunity to look at muni bank loans. So these data starts in 2012 Q3 and includes like all loans above 1 million in commitment size. So you can see very rich information on these loans. You can see whether these loans are lines of credit, term loans, other types of loans. You can also like see whether they're senior, like their maturity, their rate, like everything about the loan. And then the bonds are coming from the standard data source that you get muni bond issuance, emergent. And from there we get both like geo bonds and revenue bonds. So let me give you just a brief highlight of the bank loan data that we have. This chart here, the red line shows you utilized funded exposure, and then the black line shows you the total committed exposure. So like the total committed exposure is larger because you could have lines of credit that are not used. And so what you can see here that basically, if you compare to the graph that I showed you before, like we pick up approximately 60% of all muni bank lending, and the reason we don't pick up all is because we don't see small banks, right? Like the banks that we have in the sample are just the large banks in the States. Okay, so but the rich aspect of these data is that we not only see the red line, which you can get from the call reports at a very high level, but we also pick up the total commitment of the debt. Okay, so sorry for putting too many numbers on this slide. Here, like in this table, we've shown like how the bank loans like of states, counties, cities, districts look like. You have the main thing that like stands out from this table is that in terms of like the type of loan, like most of the debt to like muni entities is in terms of term loans. So this is approximately like 58% of all loans to counties, 54% to cities, and like 51% districts. For like states, you have a mixture between lines of credit and term loans. And then to a lesser extent, for all these types of entities, you have also other types of debt leases and other types that I haven't shown here. So another thing that is important to note here is that for the lines of credit, the size of the lines of credit are substantially larger than the part that has been used. So you can see for states this is approximately $36 million. Basically is the size of the line, and then only like average 6%, like the 6 mil has been drawn. You see the same pattern basically for the other types of entities. So the sample size here is large because the states could issue like these bank loans through several types of entities that they have, like say the state libraries or the basically state like healthcare unit, and so there's many different units that could issue those, but those units are affiliated with, say, the state or the county or the city government. Okay, so here I'm showing you 2 pictures for both lines of credit and term loans. And what like stands out from this picture is that most of the debt of these entities is in terms of highly secured debt. So the vast majority has first lien, and then whenever the debt is not secured, it is senior in terms of like contractual priority. Now, in terms of like riskiness, we see that there's these entities that obtain bank loans, they're substantially riskier than the entities that would have a bond rating. So approximately 18, 16, and 22% of state, county, city, and district like governments have like ratings of BB and lower. And the BB ratings have approximately 1% chance of default within the next year. The single B have approximately 4, and then like if you're rated lower, it's substantially higher probability of default. The loss given default that the banks like assign is also like not small. Okay, so in the next part of the paper, like we're just looking at how the reliance of bank debt would vary like across county characteristics. So in this part of the of our work, we are only looking at the U.S. counties, and the main reason for this is that the census data for this part of like unit structure is more readily available. So we look at three main characteristics here, like household income, population, and the total debt to income of the county. And then according to all three, you can see that lower income, less populated, less levered counties tend to have higher like reliance on bank debt. So this analysis is highly suggestive. So what we do next is we look at how the counties respond to income shocks. And we look at 2 types of income shocks. Like one of them is a longer term income shock, and the other one is a shorter term income shock. Okay, so permanent income shocks, like we adopt the methodology of Suarez, Serrato, and Wingender. So the type of income shock they use is based on the census counts. So every 10 years, the census does an actual count. Basically what the shock like here is the gap between the actual census count and the forecast. Now you would say that this type of gap could be related to basically economic growth and to all these type of other characteristics. But I think it's important to note here that the gap comes from not only from the forecast. The gap comes from the errors in actual count that the census does, right? So this paper shows that the shock, it doesn't seem to be related to economic growth. Like they do a host of tests to show that there is no anticipation of local governments, state and local governments. And to arrive at the gap, since every 10 years the census only would show you the actual count rather than the forecast, we use this type of a regression to figure out what the forecast would have been if the census did it, using the prior nine years of data that the census has on their website. And this is how we basically arrive at the gap. And just to show you how large the gap could be between the actual count and the forecast, in approximately 10% of the time we have really large differences. So I don't show it here, but we find that these differences do not seem to be spatially correlated or related to economic growth. Okay, so the response to income shocks, what we do here is we basically look at several types of outcomes, and the bank lending at the county government, and also we look at bond financing, and we have two types of shocks. We basically split the shock into positive and adverse component, and we also account for the muni size from productivity and income controls, and also include standard time quarter fixed effects. And so what we find here is basically that the bank finance would go up after the shock. And so this is part A, and then figure B shows you that there is not a significant effect for bonds, and as a result what we find is that the debt share is higher after these shocks. Now just to conclude, I'm going to skip the second type of shock because we don't have time. So what we show overall in this paper is that the trend towards increased reliance on bank loans is likely to persist as more muni entities face weaker financial position. And so what we do more of in the paper is we actually discuss how this could this type of increasing debt priority could make it more difficult for these muni entities to raise debt going forward. And our paper also shows that the claimed dilution problem may be a relevant consideration for the bondholders who are already there, and then absence of a disclosure requirement like now may lead to higher cost of bond funding for the state and local governments. Thank you.
Thank you very much, Ivan. Discussing Ivan's paper is longtime friend of the conference, Colin Mcnaught, who is co-founder and CEO of BondLink. Colin has more than 15 years of experience in the municipal bond market. Prior to BondLink, Colin managed the Commonwealth of Massachusetts borrowing needs from 2008 to 2015 and did a great job keeping them in debt. Thank you, Colin. Over that time, he issued close to $25 billion in bonds and notes. His work was distinguished for its innovation and was awarded several awards from groups like the NFMA and SIFMA, as well as 2 National Deal of the Year awards from the bond buyer. A big focus of his time was on boosting the state's transparency to investors. Colin studied public finance at Harvard's Kennedy School of Government. Colin, thank you.
Thanks, Peter, and thanks to Dan and David and Rich for including me. As Peter mentioned, I was on the issuer side for a long time, and I was there at the beginning. And Muniland is full of conferences. I attend them all, for good or for bad. This is the most interesting. And I think this one has the most opportunity to actually help issuers. So let me get into why I think this paper is important and try to set a little bit of a backdrop here. So From my perspective, and this started a few years ago while I was still at the Commonwealth of Mass, there was a new dynamic in the market. I thought it was really important that issuers recognize that the rules of the game are starting to change. And disclosure is becoming super, super important. And you see that investors are demanding more, and you see that regulators are demanding more. The seminal report from the SEC from 2012 really calling out that there could be sort of a subclass of investors in Muniland, the way they're treated from a disclosure perspective. Institutional investors are being asked to do more with less. Less reliance on bond insurance, less reliance on S&P and Moody's. They're doing more work internally, and a lot of big funds are moving towards algorithmic trading. So that means getting rid of humans. And then for the issuers, the fragility of the buyer base. Post-tax reform, we've seen big buyers step away from the market. That might be temporary, that might be permanent, but there's also an expectation for higher rates. Now, we've all been thinking that for the last 5 years. It could continue for another 5, but that risk is definitely out there in terms of new dynamics for issuers. So in general, from everything I've heard from investors over the last 10 or 15 years, disclosure in Muniland is really hard for 3 reasons. 1, it's really hard to find data. 2, when you find it, it's really stale. And 3, when you finally find that data, and it's really stale data, it's really hard to compare apples to apples. DC should be very easy to compare to Los Angeles, to Chicago, to Boston. It's not, for a whole host of reasons. Not anything to do with issuers, but those are major obstacles for investors. And then the sort of the makeup of the market, 50,000 different issuers, 1 million bonds outstanding, it's really, really difficult. So these are my rules of thumb here. Where you're going as an issuer is much more important than where you've been. So your interim data, getting that information out, is much more important from an issuer. What happens in between bond sales, which is what Ivan and Tom's paper was getting at. Let investors decide what's important. So it's really not up to bond counsel or for you as the issuer, but get it all out. Get it all out. Get the good news out fast, get the bad news out faster. I think that's what we're supposed to do on the issuer side. So I think the timeliness of Ivan and Tom's paper is spot on. Bank loans have absolutely exploded. There's not a lot of good data on what's out there in terms of the volume, the pace, or what's in these documents. So the MSRB is really, really focused on this over the last couple of years and been very, very active because they have big concerns. These are not, direct loans are not securities, so they don't fall under the traditional 15C212 requirements. There's no requirements to post these documents. Despite a relatively attractive environment for any type of credit to issue bonds, even lower rated counties, for some reason these products have exploded onto the scene. And when I was still in the issuer side, I was pitched on direct loans, and the idea was these are much more efficient than issuing bonds. It's one investor, it's one quick negotiation. There may or may not be a QSIP, there may or may not be a rating, no disclosure requirements, very, very easy and fast capital. And what Ivan and Tom were looking at is big issuers versus small issuers. So the focus as well in their paper on competing claims, from my perspective, wasn't really an issue 10 years ago. It is now, through bankruptcies and high-profile bankruptcies and defaults. You have Detroit, you had Puerto Rico, and a whole host of others, trying to decide who gets first claim. And the whole issue around smaller issuers versus larger issues. Mark Jaffe put out a paper a few years ago about the fees associated with raising capital, and the fees are significantly higher for smaller issuers. So in Tom and Ivan's paper, they're really focused on the decisions being made at these smaller organizations, smaller counties who tend to be poorer. And if their analysis is true, it's not a good sign. From my perspective, all issuers should take a long-term view of the market. So to experience a credit shock, and I'll get into that next, and then to decide on the most expedient form of capital, which could include provisions that are going to hurt the county over the long term, is a major obstacle that the whole market should see as a big concern. And the market really suffered 15 years ago, 20 years ago, when interest rate swaps became a major problem. That was a whole host of bad headlines for the market. It definitely impacted investor participation and raised credit concerns. And this smells the same, this direct loan issue, if the data is correct. So the major assumption here is that all of these agreements include senior claims. And I just know from what I've seen, and that was a few years ago, that they didn't, that they weren't all uniform. And there were not uniform acceleration provisions. Obviously, if you're a bondholder at a big fund or big insurance company, or even mom and pop, you don't want the issuer to enter into an agreement where there's a senior claim or acceleration. The whole idea behind disclosure is not just documents and data, it's trust. So if you're a institutional investor or retail and you're lending money for 20 years or 30 years to a large county or a small county, and then they turn around and enter into a side agreement with a bank with acceleration provisions and a senior claim, and that is also not disclosed, so you don't find out about it until you see the next audit, which could be 9 months from now. That's a major problem. But that is a big assumption that these agreements have senior claims. I will defer to the experts on whether that data can be picked up from the Federal Reserve filings. The economic shocks, the long and the transitory, I think they're excellent tests of the theory. I really like the census test, the way that the census makes an adjustment, the way that it's rolled in over the course of a few years, and then the county adjusting to that shock over the next few years. The second, the transitory, I understand why you'd want to test the transitory. Being from Boston, where we are shocked by snowstorms several times a year, I'm not sure that is the right test. Just anecdotally, my understanding of county government, counties from an income perspective are much more reliant on property taxes as opposed to a sales tax or an income tax. So to me, looking at the effect of a snowstorm, I don't know that there'd be a major credit event for a county which would require them to totally change the way that they raise capital for the bridge project, so to speak. So again, I would look, if this is still in draft form, if you're taking another run at looking at the effects of a shock, maybe looking at the prices, home prices, which is something that Christine Cuny looked at last year in her paper on disclosure. So changes in local prices are observable and correlated, and it's the largest owned source of revenue for most local governments. So my recommendation, I think the paper is spot on. There's a big if there that all of these agreements have senior claims relative to public bondholders. If that is true, that should be a major concern. My suggestion for the researchers is to take another stab at the second test and use a different test to tease out whether this is actually impacting smaller and less affluent counties. And that's it.
Great, thank you both. And we are now going to start the Q&A portion of the discussion. Maybe first, give an opportunity, Ivan, if you wanted to share any thoughts on the discussion that Colin provided.
I just wanted to say these were awesome points. Thank you so much. Yes. The first point that you raised, that we may have to do more to look at how the bank loans might be senior, more or less senior than the bonds. This is something that we're working on, but this would actually require us to match the sub entities within the state or the county. And so that's all the work, but we're going to have this in the next draft. Because this is the key, basically. We have to show that exactly, that the bank loans are more senior than the bonds. At this point, this seems likely, because bank loans seem to be substantially shorter term, as well. So even in time, even if you look at how bonds and bank loans are paid over time, if you have bonds already and then you have a new very short-term loan, then I think this would give a higher seniority to the loan. So yeah, so this is a very good point. The second point about the shock, so the major reason we used snowstorms is because we wanted to see how these entities respond to short-term shocks as well. And I think the surprising result that we find there is that the munis, they tend to increase bank debt even though the shock is supposed to be very short term. And so we find that at the end of the year, even though the snowstorm occurs in Q1 of every year, we find that at the end of the year you still have some outstanding draw under the lines of credit. So that's what the point of the shock was. Thank you, though.
Great. So we'll open it up to questions. I would say let's just keep the questions away from election meddling. Okay, great. Yeah.
Rich Rifle, watch you. So I'm wondering, in light of Andy's paper yesterday about the impact of advance refundings, and it's likely that we're going to see the data shows that after tax reform we have less bank placements. So moving forward, less likely the bank market will be active. Do you think the role of banks will increase, rushing in to do some of the things that Andy suggested might happen in the public markets, but that are difficult to do? So short calls, more par coupons. Notwithstanding the fact that banks are generally issuing or buying short pieces of paper, I could see banks being a much better, more efficient way to fund munis moving forward, even though it's not as financially advantageous for them now. So that's directed to both you and Colin. So.
Yeah, that's a very good point. Here? Okay, that's a very good point. If you look at the chart I had on the second slide or the third slide, it seems like the bank loans have gone down a little bit from the trend in Q1 of 2018, but this drop is not very large. So based on the chart, it seems likely that this trend is going to persist. Also, if you look at my census shocks, you would see how one of the major factors there would be how well they're doing financially. So if you have a lot of these entities that are not doing so well, then you might have them being more likely to issue bank loans. But based on what I have, it's really tough to say how this is going to keep going.
Yeah, I agree, Rich. I'm not smart enough to give you a smart answer to that question. I think products should really come from the issuer side. And 2012, 2013, 2014, 2015, rates are at 2.5%, 3%. And I'm on the issuer side being pitched these bank loans. Capital's been very, very easy. And I'm sure there are going to be products that are developed to respond to demand for an additional refunding. But how those products are structured should really come from the issuer side. And I think what the MSRB has done in terms of highlighting the potential risk of these bank loans has been really, really important. We can argue about the form of that relief or that disclosure, but the fact that the regulator highlighted it with the work of the SEC, I think is really, really important. So we're not going back down the path of a lot of small issuers entering into agreements that they probably shouldn't have, like you saw with interest rate swaps 10, 15, 20 years ago.
Yes, Steve.
This is for Colin. I know at the Commonwealth you did.
And you are?
Oh, I'm sorry. Steve Winterstein, Woolmeans Trust. I know you spent a lot of time at the Commonwealth on transparency. I loved your quote: "Get good news out fast, get bad news out faster." That's a good adage to live by, I think, if you're an issuer. And you're doing God's work now with your new company, BondLink. But what I'm really interested in knowing, sorry for the shameless plug, but what I'm really interested in knowing, Colin, as you talk to these issuers, and you spend a lot of time meeting those who make these decisions, do you think that they understand the importance of disclosure when it comes to bank loans? And are they empathetic and even sympathetic to bondholders that were placed in this awkward position of not knowing, and that it's their job to get that information out? What's your sense of a trend?
Yeah, no, thanks for that question. And I'm going to share my parents that someone said I'm doing God's work. And I'll share that with my wife because I'm on the road so much. They will all appreciate that. Yes and no. I think capital is very easy to raise in this market. And I just think on the issuer side, you never want to have that attitude that you just walk up to the water spigot and turn the spigot and the money flows. On the issuer side, I try to put myself in the shoes of an investor. We're asking for several $100 million to build the bridge. We're transferring interest rate risk to that investor. Oh, by the way, we're not going to repay you for 20 or 30 years. So it's a big ask. And I thought part of that agreement was to share information with investors. I think in general, a lot of issuers spend 100% of their time focusing on the rating agencies. And that is very important. It's obviously a very visible thing, and it goes way beyond how you price. It also is something that the mayor and the county administrator look at as well. But spending 100% of your time with the rating agencies and 0% of your time with investors, I think, is a major missed opportunity. I don't know what the allocation of resources and time is, but it can't be 100% and 0%. As you know, Steve, the rating is something that an investor might look at, but you're doing your own internal assessment. I actually thought one of Ivan's slides was really interesting, showing the internal ratings of banks. And one of the footnotes said that 18% of banks have states rated below investment grade. That's 9 states. That's really interesting. Shops like yours, I'm sure, Steve, you're doing your own credit work. So I think it's really critical for issuers to also go to the investor side and ask investors, what do you want? Do you want a 5% coupon, a 3% coupon? Do you like direct loans? Should I be disclosing these? I think it's a conversation that you need to have with your lender.
Yes, Dan.
What is the Dan Bergstresser, Brandeis? What is the penetration of financial advice? Where issuers that are borrowing through bank loans, are they typically doing this hand in hand with a financial advisor? And the same would go for people who are doing P3s that embed borrowing. Are they typically doing these types of things with advice from a financial advisor, or are they doing it unadvised? We have an advisor.
I can take a stab at that as an advisor. I think that's probably correlated in some ways to the size of the issuer, but I think for the most part now, issuers are using advisors. When you're looking at P3 deals, which are actually fairly few given the amount of talk about them, those definitely have one, if not multiple advisors on those. But I think with bank loans as well, it's rare now that an advisor is so distant from an issuer that they're not around somewhere. That's a good question, though. Yes. No.
Hi, I'm Adele Morris. I'm an economist here at Brookings, and I work on climate and energy policy. So this isn't my field, but I'm very interested in what you found about the increase in bank loans. You mentioned that a lot of these loans are collateralized, and I'm interested in what kind of collateral exactly we're talking about. And were the loans to default, how easy or hard is it to actually collect on that collateral? And a separate question is, I'm curious about whether there are different political rules or policy rules about issuing debt versus taking on a bank loan in jurisdictions, for example, where you have to vote on a bond issue, but perhaps not vote on an equivalent bank loan. I'm curious about that.
That's a good point. I would need to look into that. My data could allow me to see what type of assets secure the loan, but I haven't done so yet. That's a very good point. And I think it would help us to figure out whether these are looking like more like geo bonds or whether they look more like revenue bonds. So we'll do this in the next draft of the paper. Now, for the rules, in terms of like whether these entities could issue, this is difficult. I think this is difficult to gauge because I think I know for a fact that different jurisdictions have different rules, and it would be very, very difficult to have like one set of data on like how these rules work because there's like so many aspects. But we could look into that and see where there might be an easy way for us to like split the entities into several groups or something. Yeah, that's a good point. Thank you.
There are statutory debt requirements in terms of what's necessary to provide for the issuance of debt or taking on debt. And in many cases, statutory debt limits. But whether or not those would apply to a bank loan would depend upon how that legislation was written. And as Ivan said, that will vary often from state to state or entity to entity. Yes, in the red.
Linda Matkowski, Stern Brothers. So given that you're pulling data from the Federal Reserve, would your data set allow you to look at the cost of funding for the bank for the loan versus an equivalent commercial loan and what that differential means to them? Would you be able to pull that data so that you could gauge whether the bank is actually making an on-market commercial loan equivalent when they're going into the municipal space? Because in those instances, they're tax exempt, so they're tax advantaged back up to the bank. I was just curious whether or not there's profitability for the bank to actually be doing the municipal bank loan.
So we could not observe that, but we can observe whether the issue is tax exempt. And if you go to, this is not something I've shown here, but if you go to my paper, you could see that I have like a statistic on that. And I think it's approximately 50%, I'm not quite sure, but 50% of them are exempt, tax exempt. And I think here the same rules would apply. If the bank absorbs the entire issue and then the issue is up to 10 mil, I think that's the rule right now, then it could be tax exempt. If it's larger, then it's not. But I could see that, and I could do more work on this. I just worry a little bit. It's outside of the scope of this specific paper, and maybe this is something else I could do on the side. But yeah, I could see like the tax exception. It would have been very nice to observe the cost of like funding, but I don't see that. Thank you, though.
One last quick question.
Marianne Edmonds, Public Resources Advisory Group. Just a few practical observations from a practitioner. For a financial advisor or municipal advisor now to do a bank loan is pretty common, but it's also pretty common to be terrified that the SEC is going to come in and decide that that bank loan was really a security, and hence you are an unlicensed, unregistered broker-dealer, and the wrath of the SEC is going to come to bear. So there are some real we do bank loans. Financial advisors have to be very careful about the documentation of bank loans because otherwise they're in violation of communicating and working directly with investors. So there are a lot of practical implications like that that impact this market and bank loans versus securities.
Thank you. Thank you very much. Thanks to the panelists. I'm wondering, one last note. Dan Brookshire and I did a little research on this before, and there have been MSRB guidelines related to best practices when it comes to disclosing bank loan information. A lot of that data, unfortunately, is in PDFs that are uploaded to the MSRB site. They have threatened a classification of information that they would ultimately put together on bank loans that have come up. The last time I checked, that hadn't happened yet. But it'd be interesting to take the Federal Reserve data and ultimately compare it to some of that data. There's optical character recognition stuff that could go through those PDFs.
Yeah, so that's the first thing I did actually when I started to work on this. And then from the 50,000 state and local governments, only 75 of those had put information there. And among those 75 long contracts, I think the information
75 out of 50,000.
Yeah, 75. And then among those, I think the information on interest rates, maturities was just blackened out. So you couldn't see anything.
Redacted. It's a redacted world we live in.
Yeah.
Okay. Thank you both. All right.
Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.